Berkshire Hathaway Chairman and CEO Warren Buffett joining us.
स्टॉक मार्केट रिलेटेड इंटरव्यू वीडियो पाने के लिए मेरे चैनल को सब्सक्राइब करें और बेल आइकन को दबा दें.
Just after writing his annual letter to shareholders, and Warren, this is a big deal. It's something that the investment community kind of waits on and sees as a must-read because you spend so much time actually writing this yourself.
Yeah, too much.
When do you start writing the letter?
Well, this one I started very early because I had one section in mind. It turned out to be the last section, but when I talk about the American tailwind, I probably wrote that in late summer, and then I work around different sections, but it takes a long time. Yeah, I am not a first draft writer.
Well, for people who have been reading this for a long time, this letter was markedly different than you've written for the past 3 decades or so, because at the top, the opening of every letter in the past to this point has been Berkshire's percentage change in book value as the measure that you thought was most important. This time, you kind of stripped it out and said it's not the most important metric anymore for a couple of reasons. One is which Berkshire has changed so markedly, but also you just think it's not going to be the way that you'll be measuring things in the future.
No, it's not the more relevant figure, at least over time, not in any 1-year period, but basically it's market value, because we have become overwhelmingly an operating company, and we hope to become even more so than a company that really held a lot of stocks and bonds. I've actually talked about that in previous reports. I wouldn't have wanted to quit in a year where I got clobbered by the one I was dropping and was adopting one that made me look good. So I actually included them both in, and it was a good year to make the transition. And you said it's different. I've always had the image that I am talking to my sisters. I have 2 sisters. They're both Berkshire's, pretty much their whole investment. They're smart. They're not active in business, so they're not reading about it every day. But I pretend they've been away for a year, and I'm reporting to them on their investment. And then this year, because we may be repurchasing shares, I tried to have the vision that they were talking to me about whether they should sell their shares, and I was explaining to them exactly how I would look at it if I were in their shoes. So it's Dear Doris and Bertie at the start, and then I take that off at the end. But I'm talking to them, and I'm trying to talk to them in a manner where if they're practically entirely in Berkshire, and if they were thinking of selling some, here's what I'd want them to know before they made a decision.
To do that, you used a new description for coming up with it this time, which was the idea of having 5 groves. You being maybe a timber company and having 5 groves that Berkshire's really invested in. You broke down and looked at each of them on a case-by-case basis, one being the non-insurance businesses that Berkshire owns, another being the equities bunch that you have, the final one's the insurance companies, but you also have treasuries and cash that you're holding. And and then businesses that you own part of, not all of, would be the 5 groves. That's pretty interesting. How'd you come up with the idea of just the groves? Because it is something that somebody who's not so steeped in business can get their head around pretty easily.
Well, Berkshire, has dozens and dozens and dozens of companies. And when analysts look at it, they want to go out and figure out, how many boxes of Valentines we sold, at our candy company. And you can get totally lost in terms of looking at the forest by trying to look at every tree, because some of the trees are flourishing, some of them are decaying, and some of them are huge and important, and others are more or less twigs. So I thought I would group the assets in a way that was logical and where you could sort of figure out the valuation that you might attribute to that particular grove. And I think it's a lot better than trying to describe 80 or 90 businesses with close to 390,000 employees. I mean, we're in one of the businesses right now, and this is a very interesting business. But we've got Jordan's in Boston, we've got Star in Houston, we have R.C. Willey, and to go through every one and tell them about the latest store we opened, and it's much better just to look at them in groups because they make sensible groups.
To that point, this is the Ask Warren show, and we have gotten a lot of questions that have come from viewers, some from Berkshire shareholders, others from people who are just longtime watchers. I'd like to bring up a question that comes from Marcelo P. Lima. He writes in, and I think this comes from Twitter, Mr. Buffett, in your letter, you note that some of Berkshire's trees are diseased and unlikely to be around in a decade. Which ones do you have in mind, and how do we prevent healthy trees from joining them?
Yeah, well, I did say that, but I would not name the ones that have major problems just from a morale standpoint with the people. We're going to keep running them, but we have companies that are on the downswing as well as on the upswing, and it would be very tough. And the ones that are, as I call it, diseased, they're a very, very, very small part of our earnings. You'd gain nothing analytically, and you'd have 100 people go to work today feeling, well, we might as well give up or something of the sort. So I don't like to name them specifically, although you could probably figure some out by looking at our list of companies. There's some companies are just in the wrong industry. I mean, if you made whatever it may, well, even making televisions in this country, I mean, that was the hot industry, when I was young, and we don't do it anymore. We sell a lot of them here at our store, but so I would not like it if I were working at Company X and my boss had just got through saying, you're in decay.
You do name some of the big redwoods that you consider to be essential to the grove, though. Yeah. I think you said that Berkshire Hathaway Energy and the railroad, Burlington Northern Santa Fe, are two of the biggest redwoods that stand in the groves.
Well, they're big. Yeah, they're big. And both set records for after-tax earnings last year. Combined, they earn right around $8 billion after tax. And $8 billion is a lot of money to us. That's a third of our operating earnings. We earned 24, a large fraction of operating earnings last year, 24 billion. And those two companies alone earned 8. Now, Berkshire Hathaway Energy also has multiple companies, but the BNSF Railroad is just one big railroad.
Let's talk about that operating profit number. It was $24.8 billion, but on a GAAP basis, which you're now focusing on, it was $4 billion. And that comes because of an accounting change that came into play this time around. It was a $20.6 billion paper loss on your investment holdings that you now count back in from the huge amount of securities that you own, and then also the $3 billion write-down on Kraft. Right. You go out of your way to emphasize again that you don't think people should be looking at these GAAP earnings, even though you're reporting them that way.
Yeah, and we say the same. Well, that's the final GAAP earnings. The $24.8 billion also are GAAP earnings, but they're operating earnings. Right. And I think we had some outside tailwind on that, but they were 41% greater than any year we've ever had on operating earnings. But beyond that, we have this large portfolio of stocks and also the write-down in Kraft Heinz. But the main thing was the portfolio of stocks. And we've made a lot of money in stocks over time, but there's been years when we've lost money too. And I tell the shareholders that we expect to make money on stocks over time. We haven't got the faintest idea what years will be up or down. And then they changed the rule last year so that unrealized gains or losses are recognized through GAAP income. That had not been true for dozens and dozens and dozens of years before. So that changed our figures. But that's what I explain. That's why I tell Doris and Bertie what's happened in accounting during the year as well as the business.
But you should point out, this time it was a decline of more than $20 billion. There will be quarters where you'll see a huge upswing, and you don't think people should pay attention to the upswing either.
No,
that these are just fluctuating numbers.
No, they should pay attention to how we do over 10 years in the stocks we own. But actually, the way the rule works now, every minute it's recorded in earnings. It's mark to market, and we're buying stocks that, in some cases, we will hold 10, 20, maybe even longer years. And those companies are retaining earnings. They're reducing the number of shares. They've got a lot of things going for them. And I have bet a lot of money. We had $173 billion of equities at year end. And I love having those, and they will make us money over time. But I have no idea what they'll do in the next year or two.
All right, let's talk through a few other questions that have come in from viewers just regarding Berkshire while we're here. Eric LaFont wrote in and said, Warren, how have you structured Greg Abel and Ajit Jain's compensation now that they oversee dozens of different businesses? You did point out that you think the business is much better run now that those two are vice chairman, each running their own set of companies.
Yeah, our proxy will be out very soon. It shows what they received. I think unless there's some calendar quirk or something like that, they will have each received $18 million last year, and the base salary is a high percentage of that, and then a bonus is discretionary with me. But they're doing a fabulous job.
Bonus is discretionary, just based on
It's based on how I wake up in the morning, yeah.
on that same sort of.
That may be the only one you'll read about like that in a proxy statement.
There's another question that comes in regarding Greg and Ajit that says that this is from the Rational Walk. A suggested question on Monday: given that Abel and Jain are not only responsible for running most businesses but also vice chairman, shouldn't they be up on stage along with Charlie at the annual meeting? Many of us would like to hear from them.
Yeah, well, you will hear from them more, in the sense that they will be up front with microphones ready to take on any questions that come. It's not going to be that many years where the two of us are, and they will be up on the stage when we rearrange the format. And rearranging the format means rearranging me and Charlie to some degree. And it's logical for them, and I hope lots of questions get directed to them at the annual meeting, well, because we'll feed them into them. I should mention one thing about their comp. There's this rule, and I may not be giving it to you exactly proper, but there's a rule for public companies that you get to deduct only $1 million unless for compensation, unless the excess is tied to some formula. So everybody pays, you can be running the super company of all time, and they tend to range the base salary so they're $1 million or $2 million, and then call the rest something that qualifies under the IRS where they get the deduction for it.
I didn't know that's why.
Oh yeah, well, believe me, every company knows it, and their employment consultants know and everything. So you have all of these salaries, but then they have something that makes it very easy for them to make a lot more money, and that money is deductible, whereas I don't think what we pay in the way of excess, I think it's over $1 million, is deductible. But I mean, it would be a joke. And so we are paying them a fair amount of money, I believe, that's not deductible, whereas at almost any other company you see that they're designing it so that it is deductible.
I always wondered why the base
salaries it's ridiculous. I mean, it's so transparent, but it makes everybody feel good. They passed it, I don't know, 10 or 20 years ago, and immediately everybody, we just had this revelation that now that you're really only worth a base salary of a tiny amount, and they came to me about designing something like this, and I said, it's just a joke. I mean, we're not going to pay them $1 million a year. So, they've got huge responsibilities. So you'll see a little different situation. I think the bonus I give them, I think it was 16 base and 2 bonus. I think the 2 is probably deductible.
So 619 on the East Coast, and you're already making friends. Well done. Let's get to another question from the audience. This comes from Brian Chan. He asks, how are Ted and Todd's performance since they joined about 8 years ago, the money managers who were there? Have they... Ted Wetzler and Todd Combs, have they performed better than index? Charlie said recently that most money managers did not add any value compared to an index. Yeah,
the first few years, each of them, they came at a slightly different time, maybe a year to a year and a half or something, different times. And they got well ahead of the index, and they got paid compensation. Now, they got it paid, so it came in thirds, so that it could be clawed back 2/3 of it if they missed the second year, and so on. Overall, they are a tiny bit behind the S&P each by just almost the same margin over the same time.
Over the entire period.
Over the entire period, and the entire period is a little different for both of them. They now manage about 13 billion each. They've done better than I have. So
Well, that's a good measuring stick.
Yeah. So no, it isn't the measuring stick, but I mention it because if I don't, somebody else will. So they also, both of them, have done an incredible amount of work in terms of acquisitions, and Todd, and particularly on our medical venture. Anything at Berkshire, we made an arrangement with Lee Enterprises in terms of managing our newspapers. Ted handled all that. I mean, he got my approval on it, but he did a million details, and they're both. They both have contributed all kinds of ways to Berkshire, but it's been a tough time to beat the S&P, and but that's the deal we've got with them, and they've got a small carry forward of deficiency to make up. I mean, they had some clawed back earlier. They made pretty good money first few years, substantial. Some of it clawed back because of the 3-year look-back arrangement, and then now they've got a small carry forward.
Okay. Another question that came in.
They've done better than I have. I want that clear.
Tony Dickinson writes in, what changes should we expect from Geico with the transition from Tony Nicely to Bill Roberts, and how do they approach leadership differently?
They're two peas in a pod on that. I mean, they've worked together so long. They're so compatible. They have the same feelings about Geico. I mean, nobody can quite match Tony's feelings about Geico, but there's just no change. I was at a meeting of Geico that they had maybe 40 of their top executives, and everybody went around and introduced themselves and gave the length of time they'd been with Geico. I think the shortest time any one of those people said was 19 years.
Wow.
Geico grows its own.
Warren, we're just sitting down with you for the first time since the news last week that Kraft Heinz put out. There was so much news, it's hard to even summarize it all. They came out with earnings that missed expectations. They said, by the way, it's not going to get better in 2019. They revealed that there's an SEC investigation taking place into accounting. They wrote down the value of the brands by just over $15 billion. Were you surprised by any of this news? What did you think of what happened? Because the street was surprised. The stock was down over 30%.
Yeah. Well, I may have learned a week or 10 days before about something like the SEC investigation. And I'm not on the board, but Greg's on the board, and I talked to Greg, and Greg had been talking a lot to the head of the audit committee, and he's a terrific guy, Jack Pope. But the write-down, I do my own write-downs in my mind. So I was not surprised by that, although the accounting firms look at write-downs a little differently than I do, but I would not argue with them on it, and I can give you some math that would substantiate it. I've been watching. I was wrong in a couple ways on Kraft Heinz, but I think we talked the Glide luncheon time about the packaged goods brands losing some ground against the retailers.
What was that, just over a year ago?
6 months ago.
Okay.
The Glide, the packaged goods companies are always in a struggle with retailers. Our family had a grocery store for 100 years, and we went through it. Then we didn't have much bargaining power. But the really strong brands, they can go toe-to-toe with Walmart or Costco or whomever it may be. But the weaker brands tend to lose out. Now, the interesting thing about Kraft Heinz is it's still a wonderful business in that it uses about $7 billion of tangible assets and earns $6 billion pre-tax on that. So on the assets required to run the business, $7 billion, they earn $6 billion roughly after depreciation pre-tax. But we and certain predecessors, but primarily we paid $100 billion more than the tangible assets. So for us, it has to earn on $107 billion, not just on the $7 billion that the business employs. And we don't have a way. It'd be wonderful if we had a way to deploy another $7 billion and earn $6 billion, but it isn't there. So I think that when you're going toe-to-toe with a Walmart or a Costco or maybe an Amazon pretty soon, and you have a modestly good brand, maybe one where the trend's a little against or something like that, you've got the weaker bargaining hand than you had 10 years ago. The really classic situation is this, if you think about it, Becky. Heinz was started in 1869. Mm-hmm. So they've had all that time to develop various products, particularly ketchup and things like that. The Kraft part of it's a little more murky, but it goes back to C.W. Post in 1895. Those companies have brought all kinds of brands out, all kinds. You know them. You had them when you were a kid. You have them now. Some of them. They've been distributed worldwide through tens and hundreds of thousands of outlets. They've had hundreds of millions of trying. They spent a fortune on advertising, and their sales now are $26 billion. Costco introduced the Kirkland brand in 1992, 27 years ago, and that brand did $39 billion last year, whereas all the Kraft and Heinz brands did 26 or 7 billion. So here they are, 100 years plus, tons of advertising built into people's habits and everything else. And now Kirkland, a private label brand, comes along and with only 750 or so outlets, does 50% more business than all the Kraft Heinz brands. So house brands, private label, is getting stronger. It varies by country around the world, but it's bigger, and it's going to keep getting bigger.